flexibility and diverse options where you can, consistently adapt and make changes and reallocate each year to, participate in the index that you think is best suited to perform in that upcoming contract year.
Well, and the other option too, and we need to make sure people understand this, if we're in a declining market, which we could be, because the market has been at an all-time high, and obviously we're seeing declines in the market, keep in mind that Lincoln has a fixed account that pays interest daily, compounded compound interest daily. And that fixed interest rate account is about 3.5 times more, maybe 4 times more almost than what you can get at a bank in a CD. And you can put money in there if you think the market's going to go down another year. You're still going to have a client that makes a return on their investment if they feel that way. And then when the market is, in a lower point and you think it's going to go back up, then you can hop back into the index options, which is the beauty of having this product. And also mention that if a client is going to take some withdrawals from the annuity, be sure that year when they do the allocations to put some money in the fixed account if they haven't already, because you want to draw the money out of an account that's had interest paying daily.
Absolutely. I mean, we're total agreement. And, we've been seeing a lot of that, Angela. We've been seeing a lot of applications come in and fully allocating to the fixed account, whether it's the financial professional or it's the client who just, does not have a very positive sentiment in regards to markets and indexes over the short term, over the next year. We can go ahead and lock ourselves into a very strong fixed account, about 3.75%, which, as you noted, is 3.5 times that of your, CD rates that you're seeing right now. Guarantee yourself.
And the cool thing about it is it's a 1-year rate. If you went to the MYGA market, you can get a 3-year rate now, like in the 4s, but that's a 3-year rate. This is a 1-year rate. So if the market goes up again and fixed, as you know, fixed money rates are different when you're talking about an index and you're talking about a fixed account, and how that works. So it could be very possible that in year 2, that fixed account could go up. And, that's important, but also the fact that it's just a 1-year rate and it's very, very competitive, pays interest daily with compounding. And then the next year, if you decided not to be in the market the first year, you could then choose the allocations that make the most sense at the time based on, where the S&P and where the other indexes are.
Right. And I love it for its flexibility, right, Angela? If we're not too, bullish on indexes and markets right now, we can guarantee a strong first year rate of 3.75%. Then on our anniversary, versus being stuck in that fixed rate like you would be in a MYGA, you're just locked into that fixed rate. With the OptiBlend, you're going to have the flexibility to either, stay in the fixed account in year 2 if you want to, or of course, reallocate into one of the indexing strategies, and that flexibility, I think, is essential to clients. 1 year from today, maybe we've seen markets start to bottom out and we see some strength and recovery in markets. Maybe the pandemic is finally over, right? Maybe we start to see some strength in markets. Well, wouldn't you rather have that flexibility to be able to move into an indexing strategy and have the upside of 8-9% versus being locked into your MYGA rate of 4?
Yeah, we tell most of our agents and clients that this is the one product in the industry that's very versatile because it has all these different index options that are good options, but they also allow you to change with the marketplace on a yearly basis, with your clients, and offer them some extra flexibility to be able to stay with the market and make those investment choices. And a bare minimum, even the 1-year rate is always going to be more than a 1-year CD rate and anything that you could get at your bank. So it's kind of and it's tax deferred. So it's kind of a win-win either way.
Absolutely.
Well, Matt, I don't know, because some folks may not be familiar with the product at all. So I don't know if you want to officially.
Yeah, so up to you all. As I mentioned, I certainly don't anticipate needing the full hour. I'm not going to put anybody through listening to me talk about OptiBlend for a full hour, but I'm absolutely ready to roll. Whenever you are. I don't know if there's any, if you want to do an introduction or just let me kick it off, whatever works for you all, I'm happy to do.
I think it's fine. We're old friends, so if you want to introduce yourself, I think that would be great. I think you do a nice job of telling what you do. So we'll let you start.
Perfect. So do we need to bring the attendees in? Is that the next step?
No, there are, no, there.
Oh, we're live. Okay. My apologies. Well, all right. Well, then let me go ahead and get started. Well, good morning, everybody. For those of you I haven't had the pleasure of working with in the past, my name is Matt Wunderlich. I am the Regional Director for Lincoln Annuities. First, I have to start out just with a big thank you to GP Agency and Angela for your incredible partnership. You all are in phenomenal hands working with GP Agency. But of course, if there's anything that I can do to support your Lincoln Annuity business, I'm here to support you all as well. And, it is a really great time to be talking about utilizing a fixed indexed annuity for growth. I have been calling it annuity season. Annuity season occurs when two things happen simultaneously. First, you have volatility in equity markets. And secondly, you have interest rates on the rise, which is the exact environment we find ourselves in today, right? We're seeing extreme volatility in equity markets. The S&P 500 is down about 16% year to date, been hovering, down 15 to 20% year to date. So extreme volatility in equity markets. Clients are feeling the pain in their retirement accounts, seeing the negative returns and wanting to hear about ways to grow their money safely. Then secondly, we're simultaneously seeing a rise in interest rates, right? We see the Fed continue to announce interest rate hikes. As interest rates rise, that affords insurance carriers like Lincoln to more attractively price our annuity products. So we have that perfect storm for annuities, creating annuity season right now. Clients want to hear about ways to grow their money safely because of all the volatility in equity markets. And because of the rising interest rates, Lincoln is offering some of the most attractive rates that we've offered in the history of the OptiBlend product. So very exciting times. I truly believe the time could not be better to be talking to your clients about utilizing an annuity for protected growth. So I want to just cover 3 quick topics here today. First, I want to do an introduction into OptiBlend, make sure everybody is familiar with the OptiBlend fixed indexed annuity. And then secondly, I want to talk about some tremendous opportunities out there. First is the amount of money that we are seeing in the sidelines right now. And then secondly is the potential opportunity inside of retirement accounts. So let me start with the first part of today's presentation, which would be an introduction into the OptiBlend fixed indexed annuities. So hopefully everybody is able to see my screen here. This is our client approved brochure on the Lincoln OptiBlend fixed indexed annuity. Where I want the Lincoln annuity light bulb to go off in your heads moving forward is when it's the term protected growth. Whenever you hear clients talking about their concerns with the markets, the negative returns, the volatility, or worried about losing money, that's where the Lincoln annuity light bulb should go off for you. That's where the Lincoln OptiBlend fits. We are a flexible strategy for protected growth. And again, the protected growth arena, I think, is the best arena to be playing in right now due to all the volatility that we are seeing in markets. So what I like to say is that you do not have to sacrifice growth to enjoy protection. So an introduction into OptiBlend, we have 3 key benefits when it comes to the OptiBlend fixed indexed annuity. First and foremost is the power of downside protection. The client's account will never be credited anything less than 0%. So what that means is that the client can absolutely never lose money inside of the OptiBlend fixed indexed annuity. You cannot lose money. So that's always where the conversation starts. Outright principal protection, you cannot lose money by investing in the OptiBlend fixed indexed annuity. Secondly, the ability to control costs. There are no product charges for the OptiBlend fixed indexed annuity. So there's no fee. As an annuity wholesaler who's been doing this for over a decade, I understand the fact that the word annuity typically does not ring jingle bells in our clients' ears, right? But when we're able to tell clients that with the OptiBlend fixed indexed annuity, that there is absolutely no risk and absolutely no fee, we're able to immediately combat some of the major, concerns when it comes to annuities and investments. We can give clients the confidence to get invested by telling them they cannot lose money and there's absolutely no fee. But let's be honest, we're not investing to not lose money and to not be charged a fee. We're investing to grow the money, right? And that's the third and key benefit of the OptiBlend fixed indexed annuity is the upside growth potential that we're able to provide. And if you heard the conversation Angela and I were having earlier, the upside potential that we're able to provide in OptiBlend vastly exceeds that of other protected growth strategies. When you look at CD rates right now and bank investments, they're hovering around only 1%, probably not giving the clients the urgency to utilize a CD. And if you look at bond allocations in this rising rate environment, it's been a very challenging year for bonds. So when it comes to the protected growth arena, a lot of the common strategies we've used in the past, such as CDs and bank investments, they're just not providing the yield that we're accustomed to. And the OptiBlend fixed indexed annuity is going to offer substantial more upside growth potential. So 3 key benefits of the OptiBlend annuity: absolutely no risk, absolutely no fee, and we're going to provide substantial more upside growth opportunity than other no risk, no fee investments like your CDs. So inside of the OptiBlend fixed indexed annuity, one of the things that we offer is tremendous flexibility. So what I'll do is I'll quickly jump over to our most current rate sheet on our OptiBlend fixed indexed annuity. So when it comes to the OptiBlend, we offer it in 3 durations. We have a short duration 5-year contract, a mid duration 7-year contract, and a longer duration 10-year contract. The number is the surrender schedule that you see inside of OptiBlend. So the OptiBlend 5 is a 5-year surrender, the OptiBlend 7 is a 7-year surrender, and the OptiBlend 10 is a 10-year surrender. So we offer it in 3 durations: a 5-year, a 7-year, and a 10-year. You see, we offer tremendous diversification inside of OptiBlend. We have our traditional fixed account. The traditional fixed account is very attractive right now, offering 3.75% on the 5 and 7-year contract. That's more than triple what you're seeing in CD rates. So for the ultra conservative client that just wants some type of guaranteed growth, we can guarantee them a daily compounded fixed rate of 3.75%. Then after the fixed account, you'll see that we have 8 different indexing strategies that are going to offer substantial, more that are going to offer, a lot of upside growth opportunity. And I'll be sure to dive into some of the most popular crediting strategies as we continue on here today. But we offer tremendous diversification and flexibility inside of our OptiBlend fixed indexed annuity. The last few things I just wanted to touch on as an introduction to OptiBlend are some additional benefits that you can count on. The first is the 10% free withdrawals. So the OptiBlend contract offers you can access 10% of your contract value each year without any penalty. So you do have some liquidity. You can take up to 10% of your account value each year without any penalty fee. And I always like to note that that is available day one, $1. There is absolutely no waiting period. So I like to talk about RMDs, right? For clients who are taking RMDs, we can give them principal protection, upside growth potential, no fee, and we can start those RMDs right away. There is no waiting period. It's an RMD friendly contract. You can take the 10% free withdrawals immediately. So the 10% free withdrawals is a great additional benefit that we offer. And then lastly, I always think it's important to talk about the Lincoln Advantage. Again, I know the word annuity does not ring jingle bells in clients' ears. So instead of calling it an annuity, I like to call it the client's safe money investment. Safe money investment. Because that's exactly what it is, right? It's principal protected. You cannot lose. There's no fee. So it is a safe money investment. Well, if you're opening a safe money investment, the most important thing is that that be with a safe carrier, right? And it doesn't get much safer than Lincoln Financial. We are an A+ rated company, and we've been in the business since 1905. We've been in the business for over 116 years. We made it through the Great Depression. There were 55 insurers founded in 1905. only 11 remained after the Great Depression. And one of them was Lincoln Financial. Just showing the great history and strength and integrity that Lincoln has. You know, we've been through the world wars, the tech bubble, the financial crisis of 2008, and the global pandemic of 2020. And we've never been in stronger financial shape than we are today. Lincoln's market cap has nearly tripled since 2008. So when you talk about investing your money safely, first and foremost, you want to make sure that that's with a safe carrier, and it doesn't get much safer than Lincoln Financial. So that's the brief introduction into our OptiBlend fixed indexed annuity. I then want to talk about, a few great client opportunities out there for you. So what I'm pulling up on the screen now is our Market Intel Exchange tool. This is a fantastic resource that we offer. All of the content that I'm showing you is fully client approved. I want to make sure that whatever I share with you, you can share with your clients. So all of this is fully client approved. So one of the biggest opportunities I see out there right now is the tremendous amount of cash that we're seeing on the sidelines. You will see on this chart that there is almost $5 trillion sitting in cash or money markets, the most in history. And that's not surprising, right? We've seen extreme volatility in the markets. The S&P 500 is down over 16% year to date. Clients are nervous. Clients are scared about market volatility. So they're sitting on the sidelines. But when you're sitting on the sidelines, we're losing a fight against one of the biggest hidden threats out there, right? And that's inflation. That's the big buzzword today, right? Inflation. And each day that cash is sitting on the sidelines, we're losing that fight against inflation. Our money is losing purchasing power each and every day. The most recent CPI data showed inflation as high as 9%. I like to kind of put that into real numbers, right? The CPI 9% is kind of a hypothetical or kind of an abstract figure. So let's look at a 5% inflation rate, right? Which is very generous. And what that does to your purchasing power if it's sitting in cash. Well, your $1,000 today is only worth $950 a year from today and is only worth $815 5 years from today. So what can we do to give investors the confidence to get off the sidelines and get back invested? Well, what better way to give clients the confidence to get invested than to show them an investment, a strategy that has absolutely no risk and absolutely no fee, right? We can show our clients that there is no risk and no fee when it comes to the OptiBlend fixed indexed annuity. So we can give them the confidence to get back invested. So that's one of the biggest opportunities I see out there right now is the tremendous amount of cash that is sitting on the sidelines. The second biggest opportunity that I see out there is the in-service distributions or rollover transfers of retirement accounts. We're all likely familiar with the traditional 60-40 portfolio, right? The diversification of 60% equities and 40% of fixed income. But did you know that this year in 2022 has been the worst start to the 60-40 portfolio in the history of US markets? I mentioned the S&P 500 is down over 16% year to date. So the 60% equity has been very tough and very volatile, realizing extreme losses. But if we look at that 40% in fixed income and bonds, that's meant to be the conservative allocation, that is also having a very challenging year. We're all likely familiar with the inverse relationship between bond prices and interest rates. As interest rates rise, bond prices fall, right? We have that seesaw effect. As interest rates rise, bond prices fall. Well, interest rates have been on the rise, right? The 10-year treasury is up over 91% year to date. So what does that mean? If the treasury rates are up, that means our bond prices are down, right? The inverse relationship. So that 40% of our retirement portfolio is also experiencing a loss. The US aggregate bond index is down over 11% year to date. That is the most recent number as of today. The US aggregate bond index is down over 11%. For our client approved content, this is through July. You'll see that core bonds were down over 8%. So what does that mean for the 60-40 portfolio? The equities are hurting, down over 16%. The bonds are hurting, down over 11%, meaning that the average 60-40 portfolio is down over 14% year to date. It is the worst start to the 60-40 portfolio in the history of markets. So clients are eager to hear about ways to grow their money safely, right? They're looking at their retirement accounts. They're seeing the negative performance. So they are extremely eager to hear about ways to grow their money safely. And that's exactly what we can do with the OptiBlend fixed indexed annuity. But it's not all doom and gloom, everybody, right? It's always darkest before the dawn. So I think it's important to give clients the confidence to get back invested. And a great way to show them that is with this bear market breakdown. What I love to show here is that the average length of a bear market is less than 10 months. And the average length of a positive bull market is almost 3 years. So over time, we know that markets tend to do well more often than they return negatively. But here is one of my favorite pieces that we have, which is the opportunity to embrace the next bull market. So what we did here was we ran a history and saw how markets performed 1 year after they hit negative 20%. When markets are negative 20% from peak to trough, that represents that we're officially in a recession. And back in June, the S&P 500 was negative 20%. So we hit that threshold back in June. Well, what we found is that after markets were negative 20%, the average return 1 year later was a positive 17.5%, right? Markets have proven time and time again to be resilient and be able to recover. But what I love about positioning the fixed indexed annuity is that there's some outliers here, right? In the 70s, it was still negative 27%. Nobody likes to see that. In 2008, it was still negative 30%. Nobody likes to see that. And that's where we get to sharpen both sides of the fixed indexed annuity sword. If markets do recover and are resilient, well, we get to participate in that upside recovery through the different indexing strategies that we offer. But if markets are negative and don't quite recover in time, well, we know that we're protected and we're not participating in these losses. The worst we could ever do is 0%. So what a phenomenal story to tell clients, to show them that we can give you the confidence to get back invested. If markets stay negative, you're protected in OptiBlend, but it's important to get off the sidelines or get invested so we can fight that good fight against inflation and offer that upside growth potential. So we talked about a brief introduction to OptiBlend. We offer the 5-year, 7-year, and 10-year contracts. I then talked about 2 great opportunities out there for clients that are sitting on the sidelines in cash, hesitant to get invested. And then secondly, those retirement portfolios, 401ks, in-service distributions that have really been struggling this year. 2 great assets to look at to position into the OptiBlend fixed indexed annuity. Lastly, I just want to share with you, a few of the popular crediting strategies that we've been seeing inside of the OptiBlend fixed indexed annuity. So I mentioned the fixed account. We've been seeing a lot of flows going into our fixed account. It's a very strong rate of 3.75%. So for the client that's very risk adverse, we can just put them into the fixed account and guarantee them 3.75% in the first year of the contract. But instead of using a MYGA, a fixed annuity, where you might get 4%, if you use a MYGA, you're locked into that 4% for the life of the contract, right? With OptiBlend, you get great flexibility where a year later on your anniversary, you have the ability to reallocate into some of the indexing strategies that we offer. One of the new ones we rolled out is our 1-year S&P 500 performance triggered account. For those not familiar with the performance triggered account, it is incredibly simple. And that is the beauty of it, is how simple the performance triggered account is. The account is credited a specified rate. So the way that the performance triggered account works is that at the end of the year, if the S&P 500 is flat or positive, you are credited the rate of 7.75%. What I like to say is Lincoln can make 0 equal 7.75%. If on your anniversary, the market is just 0 or better, you're going to get 7.75. If the S&P 500 is up 1%, you get 7.75. If it's up 5%, you get 7.75. If it's up 10%, you get 7.75. Such a simple and easy thing to understand for clients, but I also, more importantly, think such a timely strategy with all of the volatility that we are seeing in markets, to know that if we could just be flat or positive 1 year later, we're going to earn a tremendous rate of 7.75%. So let me share with you an example of a combination of the fixed account that I reviewed and the new performance triggered account that we offer inside of the OptiBlend fixed indexed annuity. So for this example, I'm utilizing the OptiBlend 5. You'll remember that we had a 3.75% fixed account and we had a performance triggered rate of 7.75%. In this example, I'm showing a 50-50 mix between the two strategies, 50% allocation into the fixed account and 50% into the performance triggered. In a year where the return is positive and the trigger hits and you earn that 7.75, the blended yield in a positive year would be 5.75%. I mean, that's pretty good upside for a no risk, no fee investment. If the market is just flat or positive, we're going to give you 5.75. On the downside, if the yield is negative, you would earn 1.875%. That's from your fixed account allocation. Well, that's outperforming cash. That's outperforming CDs. And that's outperforming bonds. So even in a negative market scenario, we're going to outperform those common other protected investments. It's a better rate than you're seeing in CDs. It's a better return than we're seeing in bonds. You're still getting some type of positive credit through that fixed account allocation. So let's go through this by the numbers. If you go 5 for 5 and all 5 years are positive, well, then your average annual return is 5.75%. If 4 out of the 5 years are positive, then your average return is essentially 5%, 4.975%. Why do I have this highlighted? I have this highlighted because over the last 20 years, the S&P 500 has been flat or positive 81% of the time. So the historical average of the S&P is that it's positive 81% of the time. So that means on average, you would hit the trigger 4 out of 5 years, earning you that 4.975%, just on average. If we go a little below average, 3 out of 5, you would have 4.2. And if we go well below average, 2 out of 5, still 3.5% average annual return, which is substantially better than you're seeing in cash, CDs, or bonds. And this information comes from Morningstar, the 20-year look back in the S&P 500. So in summary, we had a brief introduction into OptiBlend, highlighting the 3 benefits of the fixed indexed annuity: outright principal protection backed by the strength of Lincoln Financial, no fee investment, and tremendous upside growth opportunity. We then talked about 2 great assets, 2 opportunities to be asking clients about: Cash on the sidelines, that's losing that fight against inflation. We can give investors the confidence by showing them the no risk opportunity we have inside of OptiBlend. And then secondly, those retirement accounts, the 401ks, IRAs that are really feeling the pain of this market volatility. And then lastly, I just shared with you a blended strategy of our fixed account and our new performance triggered. I wanted to share just a very simple strategy. I think it resonates great with clients, the simplicity of that trigger account, markets just needing to be flat or positive to earn that specified rate of 7.75%. So Angela, everybody at GP Agency, again, I cannot thank you enough for your partnership. I told you I would not need the full hour here today, but I absolutely have it blocked off, and I would love to open this up to Q&A and make this interactive. I would be happy to answer any questions or address any of the other indexing strategies that I have not, that there may be interest in. So I'll pass it back over to you and see if we can open it up for questions.
Thank you, Matt. Really appreciate that. Melinda, our helpful moderator, is she can see what the questions might be.
Yeah, I don't see any at the moment.
So Matt, why don't you also speak to I get asked this question probably on a daily basis, and about how much additional premium can be added to a Lincoln OptiBlend after you've purchased the contract.
Yeah, absolutely. Great question. So it is a flexible premium contract. So you do have the ability to make additional contributions. Additional contributions are limited to $25,000 per contract year or $100,000 for the life of the contract. I apologize, it's a little small here. It is in the fine print of our client brochure. This is on page 3 of our client brochure, talking about the flexible premium, and you can add $25,000 per contract year. And Angela, I'll of course send these materials to you and Melinda to share with the attendees.
Okay.
Okay. Also too, you know, we have all of the marketing material for these products from Lincoln that we are happy to send to anyone that requests them for this particular product, the OptiBlend. And we also, if you have a client that you have in mind or a prospect, please email us, and we can also send you over an illustration giving you basically a hypothetical illustration based on the allocations that you wish to see. And normally the sales desk at Lincoln that we work with is amazing, and we will constantly consult with them as far as the different index options that Lincoln offers in this product. You know, what are we seeing that are some of the best as far as allocating those projections to your potential client, and being able to make sure that we have that right. You guys are really good about that and really helpful. So if anyone has a client in mind, would like to see illustration, like some marketing material, if you'll just let us know, we'll be happy to get those over to you.
All right.
You see any other questions, Melinda?
I don't. I do not.
Yeah. So right now, the cool thing about the fixed account too is they, for the 5 and the 7 year, they're really strong fixed account rates. And so Matt had mentioned this earlier, depending on the client, you could literally put your money in the 5 year and have it in the 5 year, which is better than a 5 year CD. Not that we would recommend that, because the other options are really good. The participation rates that Lincoln has negotiated with BlackRock on their 1 year fund is absolutely phenomenal in the industry. And also that performance trigger rate is amazing, as well as the cap rates. Most of the cap rates we're seeing from some of the other companies in 1 year S&P options are usually in the 5s. So the fact that Lincoln has an 8.75 cap rate for 1 year is extremely competitive in the marketplace.
Absolutely, Angela. I just think, when you listen to or read, a lot of leading asset managers, I think I actually could pull up a slide on this here. When you look at, a lot of leading asset managers and you ask about their 60-40 portfolio return expectations, right? We have great partners at Lincoln, from JP Morgan, Goldman Sachs, BlackRock, and State Street. And We asked what their forecast is over the next decade. And when it comes to US stocks, the average annual return forecast is right around 6.3%. And you know me, Angela, I like to keep things very simple. If we're forecasting an average return of 6.3%, and Lincoln is offering you a trigger rate of 7.75 or a cap rate of 8.75, both of which exceed the expected average annual return in the S&P 500, can I ask, why are we taking on any risk, right? Lincoln Financial will take on all of your downside risk, and we're offering crediting rates that are exceeding a lot of asset managers' expectations in the S&P 500 over the next decade. So that's where I talked about this rise in interest rates, really affording Lincoln the opportunity to offer some of the most attractive pricing we've offered. So I appreciate you mentioning that, Angela.
So, the other thing I will point out as well is that the rates for the OptiBlend 5, which is one of the shortest index annuity options in the marketplace in general. Most insurance companies do not offer a 5-year option for an indexed annuity. And the fact that Lincoln has positioned those, like the performance trigger and the cap rates and so forth, the daily risk control, to be super competitive, even on the 5-year option, it says a lot, because your 5-year option is, with those indexes are just as competitive as other carriers, actually more competitive than their 10-year options, which is impressive.
Yeah, absolutely. And a lot of that has to go with just kind of the yield curve we find ourselves in today, Angela. We find ourselves in that inverted type yield curve situation in today's economy, where we are getting more yield off of shorter duration assets than longer duration assets. So when we have that type of yield curve, we're able to very attractively price the shorter duration contracts like the 5-year and 7-year.
It's outstanding. I didn't have any more questions. I don't know if anyone else does, but if,
No.
like I said, if anyone after the call would like those marketing materials, would like to get an illustration for a potential client, please let us know. That's what we're here for, and we're happy to help.
Yeah, absolutely. Or any questions.
Also too, if you're a local agent within driving distance to Raleigh, we also do lots of joint appointments with agents where they bring their clients here, and we actually sit with them to help them at the point of sale. And then we also can too sometimes go with them to meet their clients. That is available to you as a partner with GP agency. So if you have that situation where you say, I know enough to be dangerous, and I have some prospects, and I really need some extra expertise, please don't hesitate to call on us. I'm happy to go with you as a on point of sale to also assist.
Oh, to Zoom, you could even, for those who aren't local.
Right, exactly. We can do Zoom for those who aren't local. Actually, I do probably about 15 Zoom calls a week with agents and their clients. So I'm happy to do that as well. And I do a lot of in-person appointments as well. So please let us know how we can help you.
Fantastic. As I said, you all are in fantastic hands when it comes to GP agency. I can't thank you enough, Melinda, Angela, and all GP agency for your incredible partnership of Lincoln. To the financial professionals who took valuable time out of your time today to join the call, thank you so much for your continued support of Lincoln. I hope you found the time valuable. And as Angela mentioned, anything we can do to support you, your business, your clients, we are happy to do so.
And we'll also have a recording of this webinar if anybody wants to go back and review the session.
Awesome.
All right.
Thank you, Matt, as always.
Yes, thank you so much.
Absolutely. Thank you, everybody. Have a great rest of your day.
You do the same. Take care.
Thanks.
Bye.
Bye.